Hi, Ed Harrison here for Real Vision. I am talking to Boaz Weinstein, who is the founder of Saba Capital Management. Boaz, welcome to Real Vision.
Thank you. Hi, Ed. I'm very glad to be here.
Yeah, I'm really excited to talk to you. You're a credit guy. In fact, my understanding is that you were at the venerable institution of Deutsche Bank, where I was in European leverage finance a long, long time ago. Maybe we can actually go into your background because you've been in the credit markets for quite some time and have a really distinguished career there.
Sure. Anything you like.
Okay, yeah. So take me through your early days before Saba and what you were doing in credit and what the markets were like at that particular time.
Sure. So I always was interested in micro over macro, and I was just fortunate in terms of where I was able to get summer internships and even how those came about. There's really been a huge role of luck in my start, but I was able to get a summer job when I was in high school at Merrill Lynch, working for a very venerable mother-daughter duo of stockbrokers, and I got to learn, a lot for being 15 years old, and I was able to parlay that into a summer internship at Goldman Sachs. And there, the luck was that the head of the high yield trading desk was a huge fan of chess, and that was something that I had excelled at when I was in high school. And so that certainly had a role in his interest in me being on the desk that summer. And this was the Goldman Sachs of, just after Liar's Poker, where some of those Salomon Brothers people, this gentleman, David DeLucia, is one of them, had moved to Goldman. And, I sat in this, as they used to say about the Yankees, murderer's row. I sat in this group of six where I was one of the six, and I sat next to, two over from David Tepper and one over from this great mentor of mine, Bill Troy, and Jim Zelter, who's one of the heads of Apollo, and David DeLucia and Jonathan Kolach. And all of those names are recognizable to people in the markets, some to just a few of them, and to many, all of them. And I got to be a 19-year-old kid sitting there. So I was very interested in credit, also because of where I got my spot, but also I had been somewhat more mathematical than good at accounting and fundamental analysis. And so my vintage, and maybe vintage is something we'll talk about when we think about investing styles, I needed the credit derivative market to be born. I was a summer rotator in the early 90s. Credit derivatives didn't really come about till 97, 98. And so when you were at Deutsche Bank in London, that was really the birth of the credit derivative market right after the Asian financial crisis and just before the global financial crisis of 1998 with Russia and LTCM. And so that's when I joined DB at a time when this market was just beginning.
Yeah, you bring back some memories because that's exactly. I was actually I just finished an MBA program and I was rotating through, and the first rotation I did was on the Russia desk where they were trading synthetic GKOs. If I remember the acronym correctly, and that whole thing blew up, and then that's when I moved into high yield, and as I recall, when Russia defaulted, basically there was the bid-ask spreads like gapped out and was incredibly wide, and those were really just indicative bids. When you actually went to go for the bid, it really wasn't there. The market was completely dislocated. Talk to me about your experience.
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
Those were really just indicative bids. When you actually went to go for the bid, it really wasn't there. The market was completely dislocated. Talk to me about your experience during those formative years in before credit derivatives came about, or right when they were coming into the fore then.
Sure. So it was a new enough space that it was like, people didn't know what it's going to be and if it's going to be. And there were some obscure markets that had tried to form in certain asset classes that, were perceived as being a niche, like, for example, weather derivatives or something like that, or life settlements in the years after. But credit had all this potential because, if you think about Black-Scholes and when options became much more prevalent in the equity market or in foreign exchange or otherwise, we're going back to the 1970s at the latest. Even pre-Black-Scholes, there were markets. Yet credit derivatives, there's more credit in the marketplace than there is equity. Most companies have enough leverage that the quantum of debt outstanding is so significant. And before JP Morgan did their first deals to shed some of the loan exposure, basically credit was the most unhedged risk in the market, bar none, because there was so much of it and no real way to hedge it. And so credit derivatives were really performing a very valuable function. It didn't take a crisis in 97 in Asia and a big crisis globally in 98 to show its worth. You don't need to only have insurance when the house is on fire. In fact, people typically, buy insurance regularly or hedge themselves regularly in certain markets. But in seeing all the risk that came in 1998, and it wasn't too many years later where we experienced Enron, WorldCom, 9/11 attack, where the ability to actually hedge your exposure to idiosyncratic defaults of the companies that you have exposure to, or to hedge yourself to just spread widening in the market, or hedge yourself to, one of a number of different types of risks that could be customized through various different credit derivative products. It really was the birth of something enormous. And I had a front row seat because at Deutsche Bank, basically my second luck, I mentioned the first part where I had this chess interest that a certain partner at Goldman had. The second bit of luck was, it's one thing to be at the right firm, and Deutsche was very front-footed to get into that market because while they were breaking in the U.S. Across traditional investments like trying to win mandates to bring the next Ford Motor Company bond deal or what have you, some of those had high barriers to entry. They required deep teams and long histories, but derivatives is not like that. And so DB was very aggressive to build it out when others were not. Even venerable firms like Goldman Sachs were a bit late. And also I had the luck that I had basically two bosses, and both of whom independently, the summer just before the world went nuts in 1998, left the bank. They went, they got poached away. All of a sudden I come back from my summer vacation and took a week off, and I'm alone at the desk. I'm the janitor and the boss. And then we had this incredible volatility. The VIX, it was one of those moments where the VIX goes above 40 or 50, and I got to trade through it. And on the credit derivative side, you often were leaning short because it was always easier to find people who wanted to go long, just like it is in the corporate bond market. Now, yes, we would offload that to banks that needed hedges, but it was still a nascent enough market that I think I was fortunate enough to have CDS in my portfolio. Then the market blew out. It was an incredible learning experience. How do you hedge it? Do you hedge it by unwinding it? Do you hedge it with a bond? Well, if you have a 5-year CDS, do you hedge it with a 5-year bond? Maybe you want to hedge it with a 30-year bond and get duration. And so the ability to create customized exposures, which I want to differentiate from equities. Equities, somebody, Bill Ackman, David Einhorn writes a 200-page deep analysis on the company, incredible depth, incredible work, and they go to execute the trade, and it's not something different than, my mom would do, which is you go and buy the shares. It's a very straightforward process. But in credit, you can have a view on that same company, and all of a sudden you might say, well, I really think they're going to make it, but if they're not going to make it, it's because of the next 2 years. So let me buy 2-year CDS and hedge my 30-year bond and create this kind of long forward. I'm long, but only after they pass the iceberg. Or I really think they're not going to make it, but the secured debt is worth a lot. I'm worried about it going down like everything else. Let me buy the secured debt and short the unsecured debt. And I can give you 10 more of these. And so the ability to create customized exposures really, I think, taught me about trade construction, where it's so much more complex. And to me, it's the most interesting part of the market is A against B, rather than trying to know, which is the best company. It's really about mispricings. And I think it takes sometimes a volatile environment for that to be flushed out, and 1998 was that environment.
Yeah, very interesting for me because I think that I think I was telling you before we started that we're doing a series of interviews under the rubric of paradigm shift. It's about investment ideas for a world in flux. And from my perspective, potentially we are a world in flux now, and obviously credit markets will play a big role in that. And so that's why I think it's interesting that when you talk about it, because my sense is that it's going to be difficult to be short because sizing is obviously different, and credit derivatives with CDS, that's a big part of where you can make it happen. Uh, do you how difficult is it to be short in the credit markets versus the equity markets?
Sure. So prior to CDS, or apart from CDS and CDX, X referring to the index, S referring to the single company, if you were looking at the bond market, it was very hard to be short. We all have our war stories of being short Enron bonds, but then you were bought in and you had to cover. You had no choice. You couldn't keep your borrow. A month before it really dropped another 40 points. It happened to us in WorldCom as well. And so one of the neat things about a CDS contract is that you can't be taken out of it. You have basically a short locked in. You have your borrow, in effect, locked in for the term of the instrument of the maturity. And so CDS really gave investors their first chance to really put on shorts, and it allowed converts to strip out the credit piece from the equity option. And so over time, the index and single names have had greater and less liquidity over time, but the simplicity of being able to just buy protection and customize it tenor wise or what have you is actually, it's very, very easy, and it's surprisingly liquid compared to what most people think. They think, if they don't know, that credit derivatives are an illiquid product. I have found actually the bond market to be more disappointing in terms of liquidity. And I think there's one interesting thing that's not said often enough about this, which is, in the bond market, a company issues bonds. So they're in effect the seller, and everyone buys who buys. And there are people who don't buy but might buy, but there are very few people going short through the bonds. Maybe it's a couple of percent of the float or something like that, or 5% of the float. It's almost all just long. And so when you have these moments where people want to exit, this March is a great example. Everyone's on one side of the ship, and we already, the boat is tipping because everyone was already long. Some of those people have the wherewithal to stay. A couple of them may even have the wherewithal to add, but people who have to exit, there are not enough people short who want to cover. So it's basically a market dominated by longs. Whereas in CDS, if you think about it, someone sells the protection, so they're selling the insurance, they're going long, like the bondholder goes long, but somebody on the other side is buying the protection. And this year, famously, it's Bill Ackman who hit that great trade. So we of course also have participated very much successfully this year from the short side. But if you think about it, when the market falls a ton, at that point, the short seller, who might have a long on their equity portfolio or whatever it may be, has an incentive to, just like we all worry about our risk, you're worried, well, what happens if the Fed steps in? What happens if things are overdone? And so you have a natural, it's kind of zero sum on every long, there's a short. And so the technicals are much more balanced. And so exactly when the market was about to bounce, thanks to the Fed, Bill Ackman was famously, exiting his trade at the perfect time. And so, you don't have that in the bond market, and you can have much more much worse consequences for the effect of everyone on one side of the ship. And so I actually find the credit derivative market to be a more true estimate of what the fair spread is, since you can invest from both sides.
Yeah, I think that's a good point. And I want to go forward into March and then now in terms of this paradigm shift. But let's backfill a little bit. But in terms of you're getting to Saba, one of the things, by the way, that you said that resonated with me when I was talking about European high yield, which was an asset market when I was there. This was in the mid to late 90s. In 98, there was no action. Basically, everyone was long. And if you wanted to, the market dislocated. It was a gapping down of prices. It was a complete disaster. and it was completely unrelated to the market that we were in. I mean, what happened was in Russia, and therefore you had this sort of contagion into all sorts of uncorrelated markets, which is why it was important for long-term capital management to get cleaned up, because if that didn't happen, you would have had a real problem in terms of banks and their portfolios.
Yeah, absolutely. It really caused investors to realize that actually this product has a great purpose, because one of the most important things in credit is to be there with your finger on the buy trigger to go long at those moments, because that's where a lot of the return is going to be captured. In the environments where credit spreads are very tight, when you have this fixed income and the income is marginal, it's really asymmetric against you. Now, maybe the bad event won't happen. Maybe the Fed is there, but it's those moments when spreads are very wide. And sometimes, the path dependency of being an investor, where if only you would have had enough insurance in the times when people couldn't see the clouds forming, the rain clouds, if only you would have had that, you could, in those moments, like in March this year or in summer of '98, you could buy. And so I think we performed very well at Deutsche Bank in 1998, and even that led to our ability to expand into trading related strategies like credit derivatives against equity derivatives, for example, is something that is still even today not that well understood. So I think that how a credit investor is able to navigate bear markets as a percentage of the total value that they're adding, the total alpha, is much more important than equity markets. And I'd like to kind of explain that a little bit differently, which is to say, take an equity portfolio. Somebody finds 20 stocks they like. Let's imagine they're kind of buy and hold investors, or they're not day traders or short-term traders. A year later, 5 years later, some of those stocks might be up 100, 500. If it's Tesla, 1,000. Some stocks might be down 80 or 90. But there's going to be a range of everything in between, from down 100 to up 1,000. In credit, back when pre-1998, when you were just starting, or in plenty of periods where you've had very low default rates, you'd make that same investment in a basket of bonds. 5 years later, they all matured at par. Like, whether you got in at a certain time and things got rocky or didn't get rocky, it didn't matter. Like, if you actually could just sit on it, or if you were in private credit where you don't even mark to market in a daily sense, if 99.5% of investment grade companies are not going to default 5 years later, and 90, and every year in high yield, only 2% on average or 3% are going to default, at corporate credit, almost everything is not going to default. And so the steps that you're going to take are generally not going to matter in the good markets. What's going to matter is, did you, like Jim Chanos, see Enron coming? That's not one of my skills. I'm not good at finding who is, other than Jim Chanos and a couple others, finding needles in a haystack of where there might be a fraud like Enron. So that's one thing that would add tremendous alpha. But the other, which I think we do quite well in, is figure out what portfolio is going to perform poorly, given that there's been a bad market. And I'm suggesting that, unlike equities, where things even in good years are up and down and side to side, in credit, it's only in those volatile moments where you see real differentiation. And if you can predict in a bear market what will do poorly, you also will be in a very good position to buy at the right time, because you'll have had decent returns. And that's really been the story for us this year, is to see significant mispricing. Even a credit event would occur. It occurred, and then there were huge opportunities for relative value. And that's where I think a credit investor earns his keep, is in those bear markets.
Yeah, the elephant in the room is obviously the March timeframe. So let's just jump to that, because when you talk about mispricings, I'm thinking about the January, February timeframe that you were talking about with regard to Bill Ackman and his positioning. What were you seeing there, and how were you positioned, and why?
Right. So what he did was very blunt and very effective. He saw COVID. He saw the market not reacting to COVID. And by the way, I know this from what I read. I happen to know Bill. I'm friendly with Bill, but all this is out there. And he saw this problem, and the market was not recognizing it. He very very aggressively put on a hedge, and very aggressively took off a hedge at perhaps even more perfect a time. For us, it was much more nuanced, which is, coming into the end of 2019, I was seeing really extremely little differentiation between company A and company B. And when I say that, and it's not like reading the tea leaves about, our credit team to figure out which company is the paper company that's more likely to go to junk and which one's more likely to get upgraded. There were legitimately lots of high yield companies that are rated double B and not on their way to triple B, either stable or on their way to single B, that were trading at the same level as companies like Verizon, McDonald's, Disney, Walmart, and the only way you can have a world, because the world that you were in leverage finance and I was in, you don't have a world where McDonald's is trading the same as, for example, I'll give you one, Sabre, which is an online travel company, SABR. They were both trading at something around 25 to 30 basis points at their lows. And no one in their right mind would suggest that the chance that McDonald's would default or blow up is like anywhere. It's a trivial, if not 0%. And the credit spread, you could argue, ought to be zero because it's never going to happen. Yet there are forces in this credit market that make for the importance of technical investing rather than fundamental investing crucial. In the credit market, there are bank desks that are set up to hedge counterparty exposure. And that counterparty exposure can change if the dollar moves, if interest rates move. And banks make loans to the biggest companies in the world, like McDonald's, Disney, IBM. IBM goes and buys Red Hat. The banks have a lot of exposure to hedge. And so you can have a bank needing to shed that exposure, bidding up the price of IBM CDS. It went from about 30 basis points pre-Red Hat to 90 after Red Hat. This is before March. This has nothing to do with COVID. IBM's default probability didn't triple. It was still effectively zero. I think most people would agree. Even now, it's effectively zero, yet it went there for technical reasons. At the same time, there's an opposite technical called index arbitrageurs, and I'll only go there if you make me, where they are trying to sell protection on a basket to create a perfect arb for themselves. And so they have protection to sell, and they're not credit fundamental investors. And in that basket was Sabre. There were a lot of companies, including United Airlines, where people know whether it's terrorism, energy related or a crisis, airlines tend to do poorly. Yet United Airlines and American Airlines were trading at double-digit spreads. And they have a history of defaulting. So you can have that world at the exact same time in the exact same credit environment where you have the world where IBM and AT&T are trading at the same level. And so that lack of differentiation, Ed, is something that I had not seen before to that effect. Basically, you could call it a race to the bottom. All spreads came in other than deeply troubled companies, and it all was clustered at the same level, more or less. And what we were good at was picking out, in a carry neutral format, let me go long one and short the other, offset the carry. Which ones, if proverbially, it hits the fan, which ones are going to go from 80 to 800 and which ones are going to go from 80 to 120. And so that was our big theme, and it worked incredibly well. Our win-loss rate on making those picks was higher than I could have possibly expected. And the interesting thing is that the market has such a short-term memory. And now that the Fed has its hand in the marketplace, even though lots of companies have defaulted on the high yield side and none really on the investment grade side, I again see today, the last 3 months, we've seen tremendous compression. You can blame TINA, you can blame, there's no alternative or fear of missing out, that low rates, that again, there's a lot of companies, in my view, that are trading on top of safe companies in terms of their spread, the same spread. Risky versus safe is not being differentiated. And I feel like, I don't know if the market will fall again, but I feel like the trade is back, and we're very excited to do tail protection in this way and not have the negative carry that Bill had, even though he only had it for 3 weeks.
Very interesting. The place that I want to go, actually, I wasn't even thinking I was going to go there, is the Fed, because you mentioned that. There is no alternative. The Fed, they basically went from saying quantitative easing is all about buying up mortgage-backed securities and government bonds, to saying, there was a dislocation in March, and under certain circumstances, we're going to buy individual names in the high grade sector. We're also going to buy potentially ETFs in the high yield sector. And the sense that I get is that many people are saying, okay, then that gives us a floor. The Fed's there to back us up. So there's no need for differentiation. We can just buy indiscriminately. The Fed will bail us out. What do you think about that mentality? Is that prevalent in the marketplace right now?
Definitely, the Fed is the reason that everyone points to, but it's so strange to me because when I think about what happened this year, just the number of defaults. Diamond Offshore, Chesapeake Energy, J. Crew, J.C. Penney, even things that are near and dear to my kids' heart. I saw, Cirque du Soleil went out of bit, filed for bankruptcy. Not Cirque du Soleil. My kids love that show. So, it Hertz, things that people didn't expect to default. Hertz was trading at par 1 year before, default. So, I think that, whatever the Fed has done, it's not like they stepped in and stopped companies from actually defaulting and did away with that. And so really, when you think about default, it brings to mind the expression, you've got to hunt where the ducks are. Like high yield is where there have been defaults. And so the idea that high yield is interesting simply because there's no alternative. I mean, there is an alternative, which is cash. I think people in moments where the market's scary. Now the market so far done very well through the U.S. presidential election, through now we have this great news about vaccines. But when the risk, as suggested by the VIX or other other indicators, was showing you that there was real big range of outcomes for what might happen, and you as a credit investor are only going to get this fixed income, this asymmetry. You're going to get this low spread, or you're going to suffer. And you have very little margin of safety by any historical standard. Having some money in cash or in whatever would be ultra safe and being out of the market in a sense, waiting for a pullback, I think is definitely underappreciated by people who think that they have no alternative. So, what the Fed did with ETFs, in some sense, responds to what I was saying before about that there were too many sellers. ETFs started to trade at deep discounts to their net asset value, even though there's an arbitrage relationship between an ETF and its sum of its parts. There's a creation and redemption mechanism to keep it tethered. It became untethered. The market became really unruly. And I think a lot of it has to do with this problem of too many retail investors, too many investors in daily liquidity products, all wanting the exit at the same time. And so if you've seen this year a very high default rate, you shouldn't be surprised that the default rate doesn't immediately drop back down if we start having some further economic pullback, with these new lockdowns and so forth. I think that it's still going to affect high yield disproportionately, and the spread that investors are earning does not compensate them. It certainly didn't compensate them this year. We had 10 names in the high yield index out of 100 companies, the CDX, 100 companies, equally weighted. 10 of them defaulted in the index that was on the run in January. And I mentioned a few of them already. I'll spare you all the others, but 10 in 1 year, to me, it doesn't seem like getting a spread of 3% or 3.5% is just compensation. So I think we're in a very weird moment where the market is saying all clear sign. But if you're an equity investor, you have real upside. If you're a credit investor, net of the defaults that are already priced to happen, there's still deeply distressed names in these indices. I think it's a very meager return that's left over for perhaps considerable risk.
It was interesting when you mentioned retail investors and also liquidity, because there seems to be a liquidity mismatch, if you will, between the actual bonds themselves and the ETFs and how they trade. These ETFs, retail investors can get into them and they can trade in and out as if it's an equity, but the underlying instruments are not equities. They're not traded by the second on markets. And so it suggests to me that if there's any dislocation in the market and people start to pull out, then you're going to get the disproportionate reaction that you already talked about, that the Fed had to intervene for. How does that work in terms of individual names in the CDX versus the actual CDX itself?
Right. So for credit derivatives, we don't have this technical. We have decent balance between shorts and longs, but and it's not generally held by retail investors or daily liquidity funds. But I see a credit market today. Corporate credit is about $8 trillion, up from about $2 trillion 20 years ago. And at that time, or by 2008, the market was 1 trillion in 2000, 2 trillion in 2008. And at that moment, dealers were about 300 billion out of the 2 trillion. So they were about 15% of the market. And they were standing there ready to buy when the gates opened up and were a shock absorber and earning handsome profits for themselves. Today, that 2 trillion market is now 8 trillion, and the 300 billion is a mere 30 billion. So now they're like negligible at best. And so when you have investors all trying to exit at the same time, even though we've seen so many people get on, financial broadcasts talking about a wall of money that's ready to step in and buy things if ever yields backed up, that wall was, however big it was tiny compared to the outflows that were happening. And so, I think that that this issue is not fixed by what the Fed has done. They did step in to buy, up to 5% of some of these ETFs, but it's not that meaningful. These ETFs themselves are not a huge part of the credit market in isolation. There's all these other products like mutual funds, the individual bonds themselves. I think that there's been a misunderstanding of this liquidity problem, and I'm going to give you a story. Okay. Uh-huh. I saw an article, only like 3 years ago in Bloomberg about something about the HYG, the best known high yield ETF, saying it's kind of a dream product. Here you have a market in junk bonds where if you want to buy and sell immediately, the bid offer spread, they had it at 45 cents. They cited someone to say the average bid offer is 0.45%, and you need to have a high yield trader and you need to have lines set up with the banks, and it's a whole, there's all these fixed costs. Why do you need to pay 45 cents? You can go in and buy the HYG and there's a 1 cent bid offer. And I read that article, and I'm supposed to be some kind of semi-expert or expert, depending who you ask. And I said, what's wrong? What's the flaw here? They're talking about ETFs like alchemy. They're literally like saying, look, we've taken this thing that had a 45-cent bid offer. Presto, it has a 1 cent bid offer. It sounds like the greatest thing ever. What's the flaw in that? And I thought about it, and I was a little embarrassed that it took me even a minute to realize what the flaw was. And they talked about how ETFs have 45 times better liquidity than the underlying products do. And the flaw, of course, is that those ETFs have to buy and sell when they get redemptions. So it's not a theoretical. There's a 1 cent bid offer, but the PM or the index itself, when they get outflows, they have to go and sell that day. They have to meet that redemption. And what's pernicious about it is that the outflows only come when the market's falling. Right? We like draw. It's 100% correlation. When the market tanks, there will be outflows. When the market bounces sharply, there will be inflows. So on days when the Goldman Sachs of the world, who have very small balance sheets to take real risk post 2008, don't want to buy, they're being forced to buy. And when everyone's headed for the exit at the same time, the bid offer isn't 45 cents. It might be 2 points. It might be even worse than that. And so those ETFs are churning huge trading costs, selling, crossing big bid offers on the way out, buying them back, crossing bid offers when everyone says all clear sign. And so the ETF actually, aside from the fees, which are not Vanguard-like fees in these products, but the ETF is actually, in my view, a very poor structure for illiquid credit. And you've hit the nail on the head. In fact, it's acceptable unto a certain size, but the problem is that the outflows and the inflows are always so pro-cyclical, and the ETF pays huge transaction costs, which are borne out in the returns when you have big moves. And so I think this problem is nowhere near solved. We did learn that the Fed is willing to do things we didn't know before, and I of course accept that might mean the market doesn't fall as hard next time. At the same time, you can overlearn. I've also seen in my career you can overlearn certain lessons. Something happens, and there's what's the lesson to be learned from it. But you could take the lesson of Bear Stearns or Washington Mutual and say banks won't fail. You could learn that lesson, and then Lehman Brothers happens. Right. Or you could learn the lesson of the Fed and say the Fed won't let the bond market crash. But at the same time, we now have a new administration coming, and I think the general feeling among a lot of Americans on both, red or blue, is that Wall Street in the basketball game, Wall Wall Street's 100 and Main Street's 0. And so when you think about the Fed's dollars, where are they marginally better spent? You see this even as we're literally ripped off the pages of the newspaper, is this dispute between the Treasury and the Fed over what to do with $500 billion. Should they be buying corporate bonds when spreads are so low, or should that money go elsewhere? And so I'm not convinced just because the Fed, is in there buying high-grade corporate bonds until recently and lending money to some fallen angels that were investment grade until recently and buying a little bit of ETFs, I don't think the problem's fixed. And I think we are set up, Ed, for another extreme sell-off versus what the fundamentals dictate should the market fall because of this problem of alchemy, in the end being exposed for what it is.
Really well stated, Boaz. That it's almost frightening, the prospects. And the interesting bit that for me is when you talked about the setup, that it's almost as if you don't really need a bad setup from an economic perspective. What you're looking at is a lack of differentiation, which over time has to be resolved in one way or another. If you have different credits that are obviously different in terms of their risk and they're all trading at the same spread, irrespective of whether the catalyst is near term or medium term, whether the catalyst is benign, unknown, or a real actual economic event, that differentiation has to occur at some point in time.
Well, yeah, you can go a couple of years, and we've seen, leading up to this, this extreme mispricing that we invested in this way, starting in the summer of 19 was when this really became apparent. And actually, it was pretty apparent even in the summer of 18, and we set up a fund just to do this one trade, which is, since the negative carry is often off-putting, not that it should be, to people thinking about tail insurance. The idea of a carry neutral version where you have IBM and AT&T paying for your shorts, I'm giving you just a couple of examples, that became more extreme in 19. And we wondered, maybe it'll take another year or two, but the thing about credit is that you can have a single year, pay for 10 years of waiting. And in the same way, there are some credit funds this year that lost 5 to 10 years worth of their positive carry from the defaults that we've seen. So, this construction of credits that tend to do very poorly in a bear market against, let's say, the $100 billion very safe Fortune 50 company. And by the way, in that are lemons. There were credits that did very poorly for us in that environment, causing us to lose money. For example, Boeing or Rolls-Royce. But that was far outweighed by all of the credits that blew out. That Sabre example versus McDonald's, I picked them because they're both in the same spread band. McDonald's went from 25 to 60. Sabre went from 25 to 600. And so, there was enough of that. And here we are again. But, so that's one topic. The other topic of too much money in daily liquidity funds, you do need a real sell-off. It can't just be a few days to trigger something that creates a snowball. It needs to be, in a sense, fundamentally or event-related. It's not going to just happen on its own, but at the same time, it's a really big looming risk when you think about what are the things as a credit investor you need to compensate you for being long. And I think that at this time when 60-40 plans are thinking about that 40, our treasuries are going to give us the uplift when the 60 is hurting us. I think that there's room for that type of investor wondering if treasuries are going to help to think about allocating dollars to tail hedging to protect that 60, or maybe that 60 becomes 80. And there's some money spent on tail hedging, or even relative value strategies like what I'm describing, which may not in a bull market offer the types of returns that being naked long do, but have a great risk-adjusted return, which can be seen in markets like this.
As you say that, I'm thinking about the economic environment, because you're saying that there is a catalyst. Let me tell you, the story is that I've been, I'm actually in my basement at my house in Bethesda, Maryland, which is blocks away from DC. Before COVID and the lockdowns, I traveled regularly to New York. I worked out of the New York office. The last hotel that I stayed at, the last place I stayed at before the lockdown doesn't exist now. or it's on the verge of not existing. Manhattan, mid-city, right in the heart of Manhattan, hotel run by Hilton. And, that was from the first wave of the coronavirus. Now we're in the midst of a second wave. And I'm not talking about a small business here. I'm talking about a major corporation that was impacted. What happens to a company like that or similar other companies if this wave that we have now, which does seem to be accelerating as we speak, becomes something that turns into the lockdowns that we see in Europe, right across Europe? Even if we don't have lockdowns, let me say as well, maybe consumer behavior changes in some measurable capacity. Isn't that potentially a catalyst for the types of risk off that you're talking about?
Yes. Actually, I think what's interesting about your question is that it gets to the heart of why are people so confident about the path forward? If you look at the vol market, and even though vol is in a lot since before the election, it's still running at about double what it was in normal bull market times. And that, whether it's the measuring fear or measuring uncertainty, you could say measuring range of outcomes, the range of outcomes is still unusually high right now. So, what I think is really strange about what happened with the market is basically the credit market today is much more bifurcated into two groups. Either it's totally safe or it's totally going to default. And the middle has fallen out. And so one way to look at that is to, take the index, look at it by spread band, 0 to 40 basis points for investment grade, 40 to 50, 50 to 60, all the way out. If you look versus a year ago, what you find, which is kind of shocking, is that the percentage of companies trading in the 0 to 40 bucket, the tightest bucket possible, is up dramatically. Versus 1 year ago, spreads are much lower, even though we were there is no alternative. We didn't even know about COVID, and the economy was not, coming out of a recession, maybe, fairly weak. We didn't have this huge high level of joblessness that we had versus a year ago. Yet there are far more companies trading at lower spreads today than a year ago. And where it came from is the middle has fallen out. It's basically, we're in this binary, either you're safe or you're not safe. And what's strange to me about it is it reminds me a little bit of the overconfidence that the market had in its own predictions or in the technicals outweighing fundamentals to say, why should people be so confident that, whether it's your example with the hotel that you stayed at, that the darling of today cannot be the problem of tomorrow? That's always somewhat the case, but I feel like in high vol environments with a high range of outcomes, we have to, as modest, we're all should be modest before Mr. Market, accept that we're going to be wrong a bunch. And I think the market has placed way too much certainty. And I don't think it's doing it necessarily consciously. It's more, again, back to technicals. People feel the need to be invested, that basically we have this average in credit spreads. People, talk about, well, high yields at 3.5%. That is not a great way to talk about the credit market when you have some things not at 3.5%, but at 20%,
right?
Some things at 0.5%, and you talk about it as an average. There's far more clumping between the low and the high and no middle. And so what we really have to do is kind of strip out the outliers and say, well, if you weren't going to buy Transocean bonds at 15 cents on the dollar and make some kind of bet that they're not going to default and you'll make 600, 700%, if we want to strip those out, you actually are left with a very paltry spread. And what you're suggesting about why in the face of this lockdown are companies trading at such tight spreads, look, we don't have to say that they're going to default or the market's going to blow up. We just have to ask ourselves, is this the moment, which was true last week and is true today, is this the moment for the high yield ETF to be at the lowest yield of all time, right? Of all time. So I don't have to be an absolutist and say we're going back to, we're going to go to 1,000 over. It's just in high yields, there are going to be defaults. And if you're starting with 3.5%, what's left for you? And then you have all these other risks like the asymmetry, the illiquidity, the low recoveries that we're seeing for every default lately. So I think it's really about the price. It's not me coming on here and saying something terrible is about to happen. It's just the spread in high yield has gotten so compressed, especially when you do a little bit of work to take out the outliers, that people should expect basically, in my view, a negative return, or at best, a very modest return with a whole host of risks that would have been better, taken in other markets.
The interesting, the setup before we started talking, what I was told by my colleague Jack is that you have some bearishness in terms of some of these credits, but the interesting thing is that it's not because of default risk, which is what we were talking about, but it's because the rewards are capped into that you have elevated levels of right tail volatility as well as classic left tail risk that's eating into your risk adjusted returns of credit. And what you just said speaks to that to me, because you're talking about expected return being negative in this environment.
Yeah. So, one way to think about low spread credit is to not think about it as low spread credit, is to say, I'm getting this premium. Okay. And I'm getting it periodically versus option premium, which is generally upfront. If it defaults, I might have some recovery, but I'm getting this premium for what? For selling an out of the money put on default. And it doesn't have to be it either defaults or it doesn't. Sometimes, of course, as the credit is getting worse and worse, people get worried and they have to exit before it comes back or defaults or anything in between. So you're selling this deep out of the money option for a certain amount of premium. Now, when volatility is high, let's say in the equity market, those deep out of the money equity puts are much more valuable because there's a bigger range of outcomes. If you're an equity investor owning a stock and the vol is very high, so what? The vol is high. It means your stock can go up a ton as well as go down. And you, if anything, can make more than you can lose, since you're capped at, you're limited to 100% loss, but you can make multiples of that, as we've seen in certain work from home stocks. In credit, if you're getting 50 basis points right now, which is where investment grade is, or 350, but again, if we just pull out some names, it's not 50 and it's not 350, it's much lower. You're never going to make more than that. And the probability of you hitting that default node or something close, as evidenced by other markets, is higher. And so one thing that I had never seen before until the last few months, and I don't mean March, I mean like the last 3 or 4 months, is very low credit spreads, but very high equity vol of the same companies. And so we did a search of the last decade, how many companies that are rated investment grade that are trading like investment grade. So throughout the ones that are already trading like junk, how many of them have equity options with an implied volatility above 60? And you find in the history, other than like for a minute when Greece was, scaring the market and investment grade was at 3 times the current spread, other than that one quarter, it basically was never the case that you could find a true investment grade company with implied vol above 60. And you could find that in droves, just 3 months ago, and you still find some examples today. So you have the credit market basically, in my view, pricing the option at the wrong level. And the thing is, people can disagree about stuff, but there can be, well, what if I'm wrong? What if I'm right? In very low credit spread environment, if I'm wrong, it's not going to be by much, because there was very little reward. And so I think that, for investors that in the end can't be all in equities, and they do need a viable alternative, and treasuries are at incredibly low yields around the world, instead of saying, let me take credit and lever it up, let me find this mezzanine tranche of a CLO, or let me buy a BDC that's 200% levered and I'll still get back to my yield. That's investors in the worst environment to going all in because they can't get their yield the way they ought to, which is without the leverage. Instead of doing that, there are some relative value mispricings that investors like ourselves are focused on. There are some companies where the bonds of that company give you a spread 3% higher than the matched CDS of that company. So you could buy a bond, buy CDS, have 3% left over. That's almost as much as you get for high yield, which is a naked long position. And so I think this is this environment of can't get enough yield through fixed income, and the world is still murky, is a great environment for relative value, because risk adjusted, I think these trades are just far better. And so whether it's equity vol against credit spreads, secured against unsecured, bonds against CDS, we're finding an unusually high amount of opportunity for a market that is trading at its highs. All of us find opportunities when the market's down, but in this kind of bull market, it's unusual that there's this much A against B.
Yeah, and I was going to say that the interesting bit there is you were talking about the reach for yield. I immediately think about alternatives to the vanilla 60-40 portfolio. I was telling you about this before. You're not constructing a 60 portfolio yourself like a pension company, but the 40% of their portfolio in bonds, really the yields drop to the floor and they can't get any compensation. So they're reaching for yield, like you said. But part of the reason that the 40 exists is not just for the yield, but it's also because it acts as a hedge. When the equity draws down, you get some sort of return from the bond part of your portfolio. What do you do now in this case where you're not getting that? There's no compensating factor from the bond part of your portfolio.
Yes, I think that investors, it's a great time for investors with that challenge to look at relative value credit strategies. And when I say that, I don't mean relative value like we find where there's value we go long. I mean literally carry neutral strategies where we find basis points we want to buy and basis points we want to sell, and find mispricings as a way to have a very low yielding portfolio, but one that is, can you set up a portfolio that has a very modest carry either side of zero, but that will do well in a tail event? So we already talked about the long short CDS. Okay. There's also, as I just mentioned, there are opportunities in the mispricing between bonds and CDS. One example that's live was back in March and April, there was a downgrade of Occidental Petroleum, OXY. They have 40 some odd billion of bonds, and a lot of that had to leave investment grade hands into high yield hands. And you could buy Occidental bonds and buy their CDS, match maturity if you want, and you could pick up 500 basis points. Today, many Oxy bonds, instead of having 500 basis points extra yield, have a positive basis, have even less yield than the CDS. And so it's flipped. It went from minus 500 to plus 50. And so there are situations where other companies today are at minus 300, and you can buy their bonds, buy their CDS, earn 300. When I look at that and say, if I only did that, and maybe it's not scalable for a big plan, what kind of risk would I be taking to earn my 300 basis points? It would be far better than the risk people are taking right now in investment grade and high yield, where they're just naked long. And so whether it's this example or examples we're finding in secured debt against unsecured, there are opportunities in American Airlines to buy their secured loans and buy puts on the stock and leave yourself flat carry, again, either side of zero, but you have this interesting option that the company survives, but the stock isn't worth as much as we thought, since in the end the bonds have to, or loans have to mature if there's no default. And so being higher in the capital structure long against a short lower in the capital structure, these sorts of things, and I can name a few others, mispricings in the shape of the credit curve between the front end and the back end. There really is a lot to do, and I think that 60-40 plans probably are not spending enough time looking at alternatives to treasuries in things that should do well in a sell-off. Because, typically that tail protection would mean going and buying puts. But puts are pretty expensive right now. And not to say that it won't work out well if you get it right and the market cracks, but puts are often reasonably expensive. And I find the relative attractiveness of what I'm describing today to be much better than, buying equity puts or even credit puts. So relative value, I think, can have a renaissance also, Ed, because there are far fewer firms doing it. I think the last 5 years leading up to COVID, washed out a number of funds, venerable funds that were doing RV that just didn't find enough to do in that low vol environment. And I'm very glad to have sort of come out of the other side of it and find that, we've been told by one of the large banks that just the number of firms doing this kind of thing, had dropped from about more than 24 3 years ago to about half a dozen today. And I think that that also explains why we're here.
Yeah, Boaz, I spoke to a bunch of Canadian pension companies early in this year before the COVID crisis hit. And it was interesting to hear how much active management they had, how much in-house expertise they had. But when you talk about these relative value trades, it seems to me almost as if only the most sophisticated of those companies will have the acumen to do that. do they outsource to companies like yours, or how do they get exposure to this if it's outside of their wheelhouse?
Sure. I think there are a lot of institutional investors that know enough about credit to understand. It's just it's really about thinking about is now the time. It took a few years for our strategy to really play out, and so if investors had us in their portfolio as a credit fund, and you look and see, well, these other credit funds that are just effectively long and making 7 or 8% a year, all from carry, and we were not, to say, well, where do they fit in my portfolio? I think for us, we've never been bucketed like that by investors. We've been bucketed as a long vol fund that should do well in tough times, but in good times don't have to have the negative bleed of a traditional tail fund. Now, that's our flagship. There's a whole side of the business that I think investors who do need yields can get exposure to and haven't seen, which is through closed-end funds, which is something we run as a long-only, and I think is a very underappreciated long-only strategy. So we can talk about that, and I can tell you about the opportunity in closed ends. But that's another way that investors can take some of their fixed income exposure and effectively reconstruct it at a discount, and is an opportunity that's quite great in today's market, much better than it was beginning of the year.
Yeah, I'd love to hear your thoughts on closed end funds. Where's the opportunity there?
Right. So this product has been around for about a century. I was flipping through the Intelligent Investor, Benjamin Graham, and found a reference to it from early 1940s. And I've had some dialogue over the years with Warren Buffett when closed-end funds were interesting, and he once sent me his 1950 portfolio right before he was going to take that class at Columbia, where 2 out of his 3 holdings were discounted closed-end funds. So it's not like some brand new thing. What is new is that after 2008, with this huge swelling of products and interest from retail investors in fixed income in the U.S. As an outcome of 2008, yields were so high, people were so excited about high yield that many dozens of closed-end funds were created by venerable managers like BlackRock or PIMCO or whomever. And because there are hundreds of them, whether they focus in municipal bonds or corporate bonds or loans, because they're issued like equity with a fixed number of shares, if you want to get your money back, you have to sell it in the marketplace to someone else who might have a different perspective on what they're willing to pay at that moment. Whereas ETFs, if they're trading at a real discount, get tethered to NAV, other than in March, through this creation and redemption process. Just like you can't call up IBM and say, your stock's worth 200, but the market's only at 120, so give me 200, I want to sell. In closed-end funds, you have to sell it at where someone wants to buy it. And so the opportunity is this, which is, can I buy a diversified pool of bonds or loans, just like people are clamoring for in similar products like CLOs or ETFs or mutual funds? Can I buy this and why? And I buy it at 83 cents on the dollar. If I'm buying it at a deep discount, we all learned from the beginning of fixed income, 101 is if I buy things at a lower price, I get a higher yield. So you start off with a higher yield. That yield more than offsets the manager fee. And you're getting this nice yield while you wait and hope that something you bought at 83% of NAV can go back to 100% of NAV. It may not. It can take years. And that's where we come in as activists. And we've, over the last 7 years, found ourselves able in more than, I think we're probably up to about 36 examples now, where we were not only the owner of the closed-end fund, and in many cases the largest owner, but we were the driver of going to management and saying, unlike activism where a hedge fund manager has a plan and they say, well, is that a good plan or a bad plan? Literally, you asset manager managing trillions of dollars, managing mutual funds and ETFs with the exact same holdings as these closed-end funds. If you just opened up the fund, if you went from closed to open, every single investor would go from 83% of NAV to 100. They would make 17 on 83, more than 20%, right? And who would suffer? Well, they would suffer because there would be outflows. People would say, give me my 100% of NAV. I'm so happy. And they would lose some AUM. But other than that, like they say in those, no animals were harmed during the filming of this movie, like activism in closed-end funds only harms the asset manager in that they lose a little bit of AUM. But at the same time, every investor benefits. And so we've seen either the fund gets open-ended, the manager tenders for shares, which we've just seen in the case of Legg Mason to be able to consummate the merger and stay manager with Franklin. They had to come to us, the investors, and say, will you permit us to still be the manager under this new corporate structure? And they had to go and buy back shares at 99.5% of NAV. So tendering, liquidating, there are other things that can be done. And we found that, even though I didn't get into this business, I didn't get into it because I wanted to help small investors. I got into it because it was a great investment for us in 2013. I am so pleased. It's the one space that I'm in where thousands of little investors get to come along for the ride, and we get letters and emails from people saying, I was in this fund for the last 15 years, and I haven't been able to get out until you came along. So closed-end fund activism is a really neat business. It gives me great joy, and also it's full of bargains. 83% of NAV might be unusual, but we were seeing some just a few weeks ago at that level. 85% of NAV, 87. All of those numbers are only meaningful if you can do something about it. And so one of the most important things is to understand the rights of the shareholder and the election of board members, and what are the rules for putting people on the board? Because unlike traditional activism, the medicine of how do we fix it is very straightforward, and it works. And so I feel like, again, this retail space is something where I only see a few institutional investors. I don't exactly know why this many years later others haven't gotten in, but it's been a real focus for us. It's about a third of our invested dollars are in closed-end funds.
Wow, yeah, that's big, and also very nice to see that you're doing something that has meaning for retail investors as well. We can probably wrap up, and I'm thinking, what else is there left to talk about? We've talked about a whole panoply of different things, but is there something on your radar screen that we haven't covered that you're really thinking a lot about in terms of investments going forward in 2021?
Sure. Well, I have been thinking about differences, right? I've spoken a few of the difference between related instruments. I think equity vol against credit spreads. There are also the differences between what the loan officers around the banks around the US are doing in terms of tightening their standards the last few months versus the feeling like the worst is over, and thanks to the Fed and everything, getting to extremely low levels. And so I see right now a lot of conflicting signals and a lot of confusion. And my crystal ball is no better, other than I think we can recognize when things have a wide range of outcomes. And when they have a wide range of outcomes, I think my number one message for investors is that if you are exposed to asymmetry and you can only make a small return, asymmetry, the margin of safety, how much spread widening would evaporate, years worth of yield. And when that's at historic lows, asymmetry is not your friend. And having just seen what happened in March, I feel like people are supposed to be shifting not only out of maybe treasuries, that's not my expertise. We were talking about 60-40 plans, but shifting out of credit into RV type of strategies. That's one of the big points. And maybe another thing which is just more of interest is that the skill of constructing a credit portfolio and trading it is, it's so much more nuanced than asset classes that are fully electronic, like equities. Is a little bit more like a Turkish bazaar where you come in every day and there are these prices that you could drive a truck through, and your job is to, narrow down the bid offer to something. I often say to the dealer, look, I wish I was right 70% of the time, but I'm just not. So I can't cross this big bid offer or I'd be sure to lose. And so, there's this negotiation, which, it's like who the aggressor is. If I came to you, Ed, and said, I want to buy something you have, versus you came to me and said, do I want to buy something you want to sell? That whole stance can create a very different dynamic. And I think in March, what we saw, which was so interesting, was the dealers getting call some clients to say, where can I sell this thing? And instead of having that negotiation, they were so hamstrung, they just simply would call us and probably a few other accounts and say, let me just stand in the middle. I know I'm the venerable bank XYZ, but look, where would you do this? And so it's kind of sensing where the weak link is. Yes, I wanted to get out of some of our shorts in March, but if someone came to me asking for them to get out of their long, I was a very different price than if I came to the dealer. And so that kind of kind of poker, semi bluff, that kind of thing, even from the very beginning of my time in the credit market, where I'd call brokers, at 7 a.m. when I was summer intern at Goldman, and write down all the bond prices that they had that morning. The market has not changed that much. It really has not become that sophisticated. It takes months to settle a loan trade. We're still talking on the phones, and I love it. I find markets so interesting and dynamic. And whether it's the trade construction or the actual art of executing a trade, it's just so much more intense than an equity where all the work is done, and then the execution is like boring and simple, and the trade construction is generally boring and simple. So I wanted to give you that flavor because it's part of what I still really enjoy, 20 something years into it.
Great to hear. Boaz Weinstein, a true credit guy, someone who loves his field. Really a great pleasure to talk to you, and hope to talk to you again soon.
Thank you so much, Ed.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.